Hello, and welcome to the Virtual Investor Conference's March 12th OTCQX banking event. My name is Laura Hamilton, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation. Before I introduce the presentation, a few quick points. Please submit your questions in the questions box below the slides. Once the Q&A session has ended, do not log out. You will automatically be transferred into the First Resource virtual trade booth, where you can continue to ask questions via chat and access a library of shareholder materials as well as links to the company's website and other key information. Lastly, all presentations are recorded and are available for 24/7 replay at your convenience. At this point, I am very pleased to welcome Glenn Marshall, President and Chief Executive Officer of First Resource Bank, which trades on the OTCQX Best Market under the symbol FRSB. Welcome back, Glenn.
Thank you, Laura, and welcome to First Resource Bank's Virtual Investor Conference, March 12th, 2020. I'm just going to ask you to take a quick second, look at our forward-looking statement. Thank you. Who is First Resource Bank? I know we have some returning folks, but I'm going to go through this for everybody, new and old. So First Resource Bank is a community bank. We're located in Chester County, which is west of Philadelphia. We have 3 high-profile branches. Our view of branches is they need to be on major highways. They're billboards for the bank. We're always going to have a limited number, but we want them to be high visibility. We started the bank in 2005. Lauren Rinaldi, who's our president now and co-founder of the bank, is here running everything behind the scenes with Kristen Fries, who's our treasurer. Let's talk about our market. And in the past, I've referenced a bunch of awards that the market's gotten. I mean, Chester County's best places to live and return to, and the market's wonderful. We have 4 of the top 5 counties in Pennsylvania. We principally operate in Delaware, Chester, and Montgomery. Bucks is on this map. That's another one of the best counties in this little nick of the state, down in the southeastern part of the state. Unemployment's low. I mean, Chester County's below 3%. Median income is high. The numbers are there. We do not really have a specific large employer in this. We don't have a military base. We don't have any steel mills anymore. The market is literally made up of a lot of medium and small businesses that operate in the area and produce a ton of jobs and a very stable economy. Even in the Great Recession, we had some pretty significant unemployment advantages over the national markets. We refer to ourselves as a hybrid community bank, so we are not that $500 million community bank with 8 or 10 branches. We just don't think that's the model that's going to be successful going forward. We never really thought that when we came out of the gates in 2005. We think you need some high-touch branches. People like to go to the branch, a certain segment of it. They want that experience. But you have to have all the technology. You have to be able to compete with the national and the fintechs. That bar is moved up and out from when we started the bank. We continue to look at products and offerings. We'll talk later about the branches, but we're always perpetually looking at, what technology we need to have to be able to compete with everybody else in the market. I mean, internally, we talk about you don't need to be on every street corner, but you do need to be available 24/7. Obviously, that goes to the technology, mobile banking online, which is just now ingrained in the basic fabric of banking. This is a picture of our Westchester location, clearly on a sunny day. When we talk about technology-focused, we get 62% of our deposits daily through remote capture or mobile banking. We did this last year. That number was 58. We continue to see that grow on a monthly basis. I actually went back and looked at the last 2 years, and our in-branch deposits have grown 4%, but our e-deposits from remote capture mobile banking are up 35%. And if you take that another layer, our ACH activity is up 98%. So we're definitely seeing on the community bank side, getting away from checks, getting away from going to the branch. you can argue that that's a big bank thing, all the technology, but it's absolutely not. Every community bank needs to be able to provide that, access it. As we look at that technology, we internally have talked about refreshing, our biggest branch, not because it's a physical branch, but refreshing some of the technology as we go forward. So this is our largest branch, is the technology side. Look at our physical locations. We want to be efficient in what we do. We still think community banks have to have branches. We just think we need to limit them. We were in Exton. We operated the first 10 years in an Exton location, $158 million. It is one of the top 20 branches in Chester County. There's 180 branches roughly in Chester County. We opened a second branch in Westchester in April of 15. And our goal is that we want every location to be $100 million. And we got to $100 million in that location in the 54th month. We're blessed down there because we're on a corner that has $600 million. So you got to pick the right location. You got to access the deposits. You got to do a good job. We put a third location in Wayne, PA, that's on the main line, which is a local reference to the train that runs out of Philadelphia. At the end of the year, we had $5 million there, and you really need to do about $2 million a month to get to the $100 million in our estimation of the deposit gathering. So the beautiful thing about those three locations, and this is the map, obviously you guys can see the triangle, is that triangle is $12.4 billion. Exton's a pretty well-established market, 2.5. We're the largest from market share. We're the largest community bank. A market share. Everybody above us is a national player. Westchester and Wayne are both $3.1 billion, and there's obviously competition. You can see the number of branches. But when we link that up, we pick up some pretty significant markets in between that we don't necessarily physically have to be in, but because we're on either side of them, the technology, folks will want to go to the branch to open their account to start with, but then they may never go back because they're just going to do everything on an electronic basis. So gives us a huge market to access. So I'm going to look at the highlights of 2019. Now remember, all these press releases on a quarterly basis and annual basis are on our website under the investor button. Huge amount of detail, which we won't have the time to go through. So I invite you to go look at each one of those for more detailed information. Record profits in 19. Net income grew 7%. A super strong checking growth. We grew non-interest-bearing deposits 59%. Talked about Wayne. Loan growth was 15%, sixth consecutive year of double-digit growth. And as significant as everything else, we worked pretty hard this last year on reducing our non-performing assets, and that declined 54%. And there's a chart for every one of those things later in the presentation. So if we look at balance sheet growth, we talked about 15% on the loan side, 14% on deposits. The prior year, those two numbers were 13 and 12%. We continue to grow the bank, to build the balance sheet up. We're principally going to have local deposits and make local loans. We're never going to be in that perfect harmony between those two bar charts, but except for 2013, I don't know how that actually happened. So I'm flipping on to loan growth. So loan growth over the last 8 years has averaged 11%. There's obviously a lot of competition, out there in the market, but we continue to have a good market. We have never done a lift out of a group of lenders, but we have lifted out individuals that we felt were going to add to the team, and we're going to be a benefit to the organization as we grow our lending capabilities. And we continue to do that. I mean, we've done it last year. We plan to do it in the next year as we see some competitor that goes away, take the opportunity to pull out the best lender we can out of that organization. So we like that approach. It lets us absorb the overhead and lets us continue to have this bar chart that you see where the overall portfolio, is getting pretty close to $300 million. And we talked about the percentage growth in each one of these. All that growth translates to top line. So the total revenue, $15 million in 2019. We were up 19% on the top line, 18 to 19, and 17% from 17 to 18. Pretty significant top line growth when you compare that. In 2016, our top line was $10 million. So we're not doing a complete hockey stick, but we like the increases in these bar charts over the last few years. So I'm going to grab a quick drink, and we're going to look at the loan portfolio mix. There's a lot on this chart, and there's a lot more detail I'd like to go through. We are principally not a consumer lender. This part of the portfolio total between first and seconds and auto loans is 6% of the portfolio. It peaked before the Great Recession at 26%. We have intentionally not grown that portfolio. We've actually let it run off. Dollar-wise, it peaked in 2007 at 3 times the level that it is now. We do some home equity, but we really don't do a lot. In the consumer first category, half of that 4% of the portfolio is first liens on home equity loans. The other half is mortgage. So we don't really have a mortgage operation on the residential side. We do a lot of 1 to 4 residential properties that are investors. We have investors that own 3 or 4. Some of them own 100. That's just a core competency that we've had over the years. We like that portfolio. Loans tend to not be huge, and we get a chance to work with an entrepreneur who's trying to build for their future, and it's a good relationship that we've had over the years. On the construction side, 12% of the portfolio really breaks into 4 different pieces. Commercial construction that's going to go to permanent is 25% of that pie chart there. The other 75% is builders that are building to sell, rehabbers that are flipping, and some of the rehab is converted to holds. So we've always had a percentage of the portfolio, always had a core competency in construction. And we've done a good job with it over the years. When you look at owner-occupied CRE and the loans that are C&I, that's a third of the portfolio. The 2 blues that are in that chart. Business owners buying their building, working capital lines, term loans. Multifamily is 10% of the portfolio, all in Pennsylvania, all in the Philadelphia area. Never built the portfolio by doing out-of-state multifamily. We also haven't built the portfolio by doing a lot of participations in areas that we don't know. We do have some participations with other community banks where we've helped them access or keep their customer, and they've similarly done that for us. CRE, the 2 thresholds, 100 and 300. We're generally at 100 and 300. We've been that way over the years. We think we have mitigated that risk with our analysis of the CRE portfolio over the years, and we're pretty comfortable with being at those levels. And have gone through some exams and have seen looking over our shoulder on that, and we think we're fine. Improving asset quality. We peg this chart back to maybe times that we don't even remember now in 2012. But coming out of the Great Recession, we had 56 basis points of charge-off. This last year, we were 10. Over the last 5 years, we've averaged 9. Now, that's significant in that we also were working very hard to get rid of our non-performing assets to asset rate. We're trying to improve that ratio. So improving that ratio, there could be the tendency to have more charge-offs. We really didn't see that. We got it down to 42 basis points in 2019 from 245. So significant improvement. It's an area that we really focused on in the last 2 or 3 years to get that down. So we look at deposit growth, checking, and that's our internal mantra. We peg this chart back to 2011 for one particular reason. In that year, we were 6% checking with $7 million in checking. We got through 2019, we were 23% checking and $62 million. The last couple of years, and I'm going to say from 16 on, that was a big focus for us, and we improved our percentage of checking from 13 to 23, and more than doubled the total. That's going to help us in any interest rate environment, anytime. I mean, that checking group has a cost of funds of 2 basis points to us. Um, checking. We are a small business checking machine. I mean, we are, how we do it is our marketing approach is it's free. We don't do analysis checking. We want your checking. We want to take it. We want to lend it locally. We talk about our technology with our remote capture. We buy the machine. We give you the machine. We're not charging them per item because at the end of the day, we want your checking dollars so we can go make loans. We look at money market and CDs as kind of interchangeable depending on what's going on with interest rates in the local market. Those bars look like they're all over the place, and they really are. We really kind of focus on what's hot at the time and where we can get the best cost of funds to add to the profitability of the bank. I was trying to come up with a chart on the next one, the benefits of checking, and we kind of debated this. But at the end of the day, what this is showing you is the difference between our cost of interest-bearing deposits and our total cost of funds. So obviously the difference should be the benefit of checking. So at the end of the year, it was 33 basis points. If you go back down that slope and back down to the chart, in 2017 it was only 9. Earlier it was less than that. So this is a real tangible, view of what checking has done for us in the last 2 or 3 years. It's been a big improvement. It was a big focus. I remember Lauren and I were, sitting around in 16 trying to figure out, how we change the deposit mix, and we needed to throw some resources at the deposit side of the bank, and we did. And it's just nice to look at this chart and say, wow, like we did it, we executed, we brought it in. And that's just indicative of what we think are the smart, long-term things that we're trying to do to make the machine of the bank, better over a long period of time. So we jump and look at net interest margin. The peer group here has changed a little bit. We actually early on used 100 to 300 million. When we grew, we went to 300 to 500 million. Whichever one of those you're looking at, at the end of the year, we were 33 basis points better than peer. Our net interest margin at the end of this peg is 375, which has generally been our number that we're looking to try to be at or above. The gap here, which we've always had a gap here, has been 25 to 39 basis points as you look at the life of this chart. So when you go to net income was up 7%. We talked about the prior year, 17 to 18, it was up 28%, and 16 to 17, it was up 32%. Now, obviously, there was a tax change in there that had a little bit of a pop, but when you look at and say over that 3-year period, having net income up 82%, it's not all about a tax change. And we went from net income of $1,281,000 to $2,321,000. That's the growth of the bank. That's the growth of the portfolio. When you look at 18 to 19, you also had the folks that we had hired to do Wayne. We had embedded Wayne costs, even though we opened in October and the asset came on in the fourth quarter. We had looked for folks that we wanted to bring on, train them, have them be first resource people when we open. We weren't going to hire them 2 weeks before we opened. So those guys were all in the overhead over the course of the year. So, if we look at things that we're very proud of, we were best bank in Chester County for the last 3 years. Yay, this is a newspaper that's our local newspaper in Chester County. This is readership voting, and it's a cool thing. We're really proud of that. Some other accolades that we got, obviously OTCQX, best bank in 2008. And then the other two things are up here, the Westchester School District Foundation. That's our largest school district in our market area. We're very involved in the community. We were their community partner for 2018. We got that award in 19. And as important, there's a Chester County Fund for Women and Girls. We were the corporate champions of change in 2019. These are just a reflection of some of the things. We are a classic community bank from that standpoint. We're very involved in the community. Lauren would kick me if I didn't point out that we were one of the best places to work, Philadelphia Magazine. We were the only bank that year in best places to work. So super proud of that. We have an awesome team. that's been executing for a number of years and will execute into the future. Yeah, if you were part of the conversation earlier with Joe at 9:30, this chart's totally outdated now. But the benefit of it is, at the period we were looking, we were tracking pretty well with the S&P, and we're proud of that. I mean, obviously, including today, it's been a weird day in the market, and there's been a bunch of weird days in the market as we've gone along here. We go on to the last chart where we're looking at book value, and I'm going to focus just on the book value side of it, which is the blue lines. We continue to build book value. However you value the bank in the near term or the long term, it's about adding to the book value. So when we were 12, we were around 7. We're 10.10 at the end of this year, and obviously February shows a little bit better number than that. Whatever craziness is going into the market and whatever happens in the short term, in the long term, we continue to build the value of the franchise. So I'm going to get a drink, and Lauren's going to hand me a question. All right, hang on one second. Okay, so Bill's question was, what are the drivers behind the net income growth? Well, I think one of the biggest drivers is growing the bank top line. We've had a good loan on a loan yield over the years. In the past, when we've done this, we've talked about smart growth. We have typically absorbed overhead in a digestible form. We do our operating plan 3 years at a time, 3 years out. So we never really want to get in a position where we have a surprise, have a black swan out there that we haven't anticipated or can't go, kind of plan around. So I think it's good management, and I think it's, growing the bank, but growing it in a smart way so we don't have these ups and downs in net income, which generally isn't good for anybody. Steve's question, what do you expect the impact of the recent economic change to do to your net interest margin? I think we'll have some ups and downs. I mean, a little bit like moguls if we're making an Olympic reference. But I think as we get through the year, I think we'll actually see less pressure on it. We have the benefit this year of the checking. We have quite a few dollars in money market. And even though we have 38% of our deposit base in CDs, 45% of those mature this year, and they're front-end loaded. Now, I don't know whether Lauren and I were wicked smart and outguessed the market, but we thought rates would be down in the beginning of the year, so we actually had them mature now. So there'll be a big benefit of that, but as anyone that has CDs and is a community bank, there's always that lag effect waiting for them to reprice. Jason's question, can you speak to your plans for future branch expansion? The next branch is redoing the technology. That's our biggest branch, and although it doesn't feel like a construction project, like we're building a branch, that's the next expansion. I don't see a physical location in the next 3 years because I don't think we need it. If we can get the existing locations to where Exton is, I mean, you could be half a $1 billion in deposits from the 3 locations we have, and I think we can do that. The next question is, have you considered offering wealth management products? Sorry. We've looked at that here and there over the years. We have quite a few customers that are in that business that refer things to us, refer loans to us, and we've always been just a little hesitant to compete with people that are supplying us, with business like that. Similarly to a title company, we have a lot of good customers that are title companies, and we value their business, and we've tried not to get in the middle of their space. How are you competing for loans and deposits in the local market? It's hand-to-hand combat. It's been hand-to-hand combat for the last 15 years. We have a little bit of benefit from some folks that were longtime players that have been acquired, slid out of the market in the last 5 or 7 years. As we've lifted out a lender here and there, we've had access to some of those names, and I think that it doesn't make that any easier to compete, but the flow of opportunities continues to be there, and obviously we have to earn them, on a case-by-case basis. John's asking, do you have a shareholder buyback program in place? We do not. I've had that question a couple of times, obviously yesterday, but I've had it a couple of times in the last 6 months. We've actually talked about it. We've spent so much time growing and raising capital to support it. We haven't used capital buyback, but we're kind of open to everything. And Laura and I actually have a meeting towards the end of the month here to kind of continue to explore that, but making no promises at this point. How do you feel about the bank's potential loan loss if we enter a recession? I love that question, and thank you. So in the last recession, we had a lot of consumer. So the last recession loan problems were really based on two things. One, on valuation of properties, which right now the real estate market is really hot in our area, and there's actually a absence of really good properties to buy. So I think valuations will be good. I mean, the other piece of that was unemployment being not good, which meant people weren't paying the rent, which means they weren't paying our landlords. So I suspect that we may have some people that are furloughed that may have some rental payment problems, but I don't see it as at the same level. The factors are just so different. And, we've intentionally set up the portfolio to insulate ourselves from things that were a problem last time. I think we've learned from where we were. How is the bank positioned for lower rates? This is from Mark. Clearly, Mark, that's a good ALCO question. We've obviously done all the shocks of up and down, and I don't know that anybody in doing all those shocks has ever said, wow, we could have a real case, in this 2-week period where we're going to go down 150 basis points if the Fed does 100 next week. We're positioned well. I mean, obviously, we will have a little bit of a lag while we do some repricing on CDs, but we think we definitely will catch that back up as we look at some other quarters. And I think, right now with the corona, I think everybody's kind of feeling, how long is this going to be? What do we have to do? I mean, the next question, which I'll just slide right into, is how is the bank's operations prepared for the corona? We set up the architecture of the bank so that everybody could work remotely at any given time. In February, we had 30, 40 people working, from wherever they were, logging in on a VPN system. So we had that in place already. Typically, every year we have a snow day that we'll tell everybody to, except for retail, stay home, work remotely, test everything. So we've done that every year, and we're going to do that on Friday again because if you're in the Northeast, we literally haven't had a snow day to test it. So we would be testing it anyway. We think we can operate the branches pretty well with a drive-up only scenario if needs be, if there's a larger state of emergency. I mean, we're blessed right now in Chester County where there isn't a case, but clearly there's a lot of people around the country that are not feeling 100% right now, and we worry about them and we worry about the near-term effect on the economy. But we think in the long term that we'll get to the other side of this, and the bank's built for the long term. So. And as someone always said to me, make sure you ask for the order at the end. So we think our stock's a good value. We'd hope that you would consider, adding to your position and buy First Resource Bank. And you're going into the virtual investor booth.